Welcome back, students who are taking financial accounting, and in this series of videos we are covering the chapter material for Chapter 8, Long-Term and Other Assets. And we left off in the last video with the cost of fixed assets, and so in this video we are going to discuss depreciation. Now I'm not going to spend a lot of time here with the depreciation. As you can see right here, it says math for business/applications, chapter 17, and here's the web address. If you had math for business and finance, or you had math applications, we already covered. It was already, depreciation was already covered pretty extensively for straight line, units of production, double declining balance, all right, in the math for business and finance subject or the math application subject. So if you go out to the student community and under, maybe I should have put that in, so let me just write that in here. So if you go out to the student community and then you click on the words, you click on the words academic groups from the menu at the very top of the page. You'll go to the academic groups page, and on the left hand side you'll see a list of the groups. Under the automotive one, you'll see the next one is business. So click on the word business and that'll take you out to the business group. Okay, and then from the business group on the left hand side you'll see the section called math for business/applications. All right, so that'll take you, if you click on the see more or learn more link that's there, that'll actually take you into the math for business applications section. It's on the left hand side there, and you can scroll down to chapter 17, and under chapter 17 you'll see detailed videos on doing depreciation. In lieu of that, this is the web address. So if you just type this into your browser web address there, it'll take you directly there. Okay, so that's where you can find a lot of the videos. If you haven't had math for business or math applications, you can go there. The theory is there. If you need additional homework problems, the homework problems are there. I put up the problem itself, so you can pause the video, work through the problem, and then watch the rest of the video in order to see how it's worked out. So pretty much, depreciation here in this chapter, if you studied it and you had gotten it back in math for business, then this here's a no-brainer section, and that's why I'm not going to spend a lot of time on it. If you haven't had it before, then I suggest you go back and watch those videos. Okay. So, and also, of course, you have the textbook itself here, so you can, learn from the textbook. I definitely recommend that you do work on the homework problems. I mean, I'm going to work them out. So if you need additional, experience doing it, or if this is the first time you're taking it, yeah, read the textbook. Work through the homework problems. If you still don't understand something, contact an instructor and we'll help you. All right. But I don't need to spend, 3 or 4 hours creating additional videos on depreciation that have already been created before. All right. So with that said, for the math, straight line was covered before, and so was units of production, so was double declining balance. So, that's all part of that math section. Now, the modified accelerated cost recovery system, the maker system, is used when you're doing your taxes. Okay. Remember, when it comes to books of accounting, you have your financial accounting, which is what you present, which is what you use for your own analysis. You give to third parties, things like that. But then you also have to consider taxation. All right. And the two, even though they're, in some areas they do include the same concepts, In some areas they don't, and one of those areas is depreciation, where they don't. Okay, you can use straight line depreciation, units of production, double declining balance, or weighted average, and those are the four most common types when it comes to financial accounting. All right, the way you report your financial information. But when it comes to taxation, you only use one. All right, and that's makers. All right, so even though you're using straight line on your books, when it comes to doing taxes, you'd end up using the maker system. All right, that's beyond, covering the maker system is beyond the scope of this book. Excuse me. Just be aware that it's kind of like lockstep. You don't really have any choices in the matter. It tells you how many years you're going to depreciate it. There's a chart that you look up. You find the asset. It tells you how many years, and it's basically like straight line depreciation, except it's modified and it's also accelerated. So it combines both straight line and double declining. The concepts of straight line and double declining balance in order to accelerate the depreciation of an asset for taxation purposes. Right. So that's the makers. Weighted average is not in this textbook. It is one of the four common ones that are used. Like I said, let me erase all of this here. And I stuck this in, the weighted average in here, just like I stuck in the makers. The book talks about these three, and these are, generally these are easily the three most common ones. But a fourth one is the weighted average, and I'm not going to get into the weighted average. It's not in this textbook. Just be aware that if you are in the accounting curriculum, and this is the reason why I put it in there. Also, too, if you're in the accounting curriculum, when you get to intermediate accounting, the weighted average method will be covered when you go into intermediate accounting. And as anybody else for like business management or marketing, people, just be aware that the weighted averages will be used in a lot more complicated situations. Okay. But if you're working for a huge company like Caterpillar or something like that, you might come across it. All right. I realize that you're not going to have intermediate accounting, if you're a business manager. So you really don't have to concern yourself so much with it, but just keep it in the back of your head that that is an additional common accounting method, depreciation method. Also, everybody just be aware that from an accounting perspective, an accountant can make up a depreciation method, okay, just out of the clear blue sky. Okay, they don't have to use these methods, right? But if they make something up, and this rarely happens, but it is possible, because you might have a situation that you might want to be able to use that to your advantage. You can make it up. The accountant can make it up, but they have to be able to justify it, and the justification has to be sound. All right. So with that said, I'm not going to talk too much more about that. Just be aware. Straight line, units of production, double declining balance. Go out to the student community under Chapter 17 and watch those videos. Realize that makers is for taxation, and we have an additional method called the weighted average, which are again for accounts that'll be covered in intermediate accounting. And for everybody else, just be aware that that you're not locked into just one way of having something depreciated, and also realize that accountants can make up their own depreciation method, but they have to be able to justify it. Okay, they don't do things willy-nilly. So therefore, it is making something up is done, but it's rarely done. All right. Now, the other two issues about depreciation are a partial year. Now, for the partial year, in the math for business and finance and math applications, they had talked about the during the course of a month. All right, so let's say you have January 1st to January 31st. Right, so this is a month, right? Now, if the asset is purchased on, say, 125, and you're going to depreciate it, right? Because it's less than a half of the month, because it's less than a half of the month, you are not going to depreciate during the month of January. Okay, if you had purchased the asset, say on 110, because you're using it more than a half of the month, then you would capture the depreciation for the entire month of January. Okay, now this was discussed in in the math for business and finance, and it's in there, but a lot of students don't realize it, even though there is a problem. A couple exercises covering it. So basically, when it comes to when you're looking at a month, if you're going to use the asset for less than half a month, okay, you do not depreciate it for that month. If you're going to use the asset for greater than half the month, then you will depreciate it for that month. So let's just take this as an example. So let's say this is January, this is February, this is March, and this is April. And I'm not going to go all the way out to, for a long, long time here, all right? But let's say the depreciation ends up being 1,000. When you do the calculation, for, let's just say, straight line depreciation, that depreciation is $1,000 a month, just to keep things simple. If you bought the asset on 125, okay, you would not depreciate for the month of January, okay? You would start your depreciation for February through March, and when you get to the end, here's November, here's December, here's January, and here's February. So this is the beginning. What I'm showing here is the beginning of the depreciation period, and what I'm showing here is the end of the depreciation period. What ends up happening is, because this is 125, right? And let's just say it's for the entire year. Since you're not capturing it in January here, you end up capturing it over here because you use it most of the month during the, this last month. So you're still capturing the depreciation for the entire year, okay? It's just that because it's less than a half a month up front, you don't capture it, you don't use that month, but you end up recording the depreciation on the tail end of the depreciation period. Now, if you had bought it on 110, okay, well now, yes, you are going to capture the depreciation for January for this entire month. But what ends up happening is when you get to January at the end, you're not going to end up having any depreciation for the end of January. So it's just a matter of where you're shifting that first and last month to be able to capture the entire depreciation, depending upon the date that you purchase it. All right, so that was covered in the math for business and finance, but I brought that up here because we're talking about partial year. And so when we're talking about a partial year, basically what we're doing is we're prorating the depreciation for the entire year. So you're going to take the number of months the asset is used, and divide it by 12, okay? And you're multiplying that by the depreciation for depreciation, ON, expense for the entire year. So if you have, let's say the depreciation expense is $12,000 for the entire year, but you're only using it, say, 6 months out of the year, okay? Oops, 6 months out of the year, right? So that's like 1/2, so that's 12,000 divided by 2, so that's $6,000 that you're going to depreciate, for the year, right? And that's prorated, right? So it's not, the partial year, I don't. What's more important is knowing whether when the asset is put into play during the month and whether you're capturing that month. Um, just by virtue of the fact that you're depreciating and let's say you're starting your depreciation in, I don't know, say the month of May, okay? All right, and let's say you're depreciating it for 3 years, right? Well, what you're looking at here is let's say here's year 1, year 2, and here's year 3, right? And if you're starting here in May, right? So you're depreciating the year, May, you're depreciating for 7 months. And that's all, the partial year depreciation matters. So if it was $1,000 a month, it would be $7,000 for, that particular year as far as depreciation. Notice I'm not getting into a lot here with the partial year because it kind of like just falls into place. Generally, I don't even think about it that much. I just, just by having virtue of the fact that you have the information, and if you draw yourself a timeline, okay, and you're able to figure out what portions, that's all you need as far as being concerned with, your partial year depreciation. But we have the change in useful life. Okay, now this is important. It doesn't happen that often, right? Generally, most assets you can determine what your useful life is. And remember, determining what your useful life is basically an estimate, all right? And generally, you can estimate correctly what the useful life is, but sometimes, you're not going to be able to estimate correctly, and you'll find that you'll have to change the your estimate of the useful life. So if you end up doing that, let's say you estimated something to work for 5 years, okay? That's what you're going to base your depreciation on. And in year 3, you determine that, that estimate is wrong. Now that's going to be 7 years, all right? You're going to end up having this for 7 years. So what you do is, how much your depreciation is. Let's just say it's $1,000 a month. So over uh, the course of 3 years, so it was $1,000 a month for 5 years. So that's $60,000. Okay, and let's say there's no residual value. Right. So at the end of 30, your book value is $60,000. Okay, $1,000 a month. It's 12 months in a year times 5 years. Your book value is $60,000, and we have 0 residual value. So now at the end of 3 years, you've depreciated $36,000, right? $1,000 a month times 12 months times 3 years. So now the book value of your asset is the $60,000 less your depreciation of $36,000, which is for $24,000. Okay, but here you're saying, you had thought you'd only have it for 5 years, so you only have 2 years left for depreciation. But you've come to realize that no, it's not going to be 5 years, that it's going to be 7 years. Okay, So what you're basically going to do is you're going to take this 24,000 and you're going to depreciate it over the remaining 4 years. Okay. All right, 3 years, 7 years less 3 years is 4 years. So you'll take that, 24,000, oops, 24,000, divide it by 48 months, 4 years times 12 months, and you're going to come up with, let's take it here, 24,000 divided by 48 means you're going to have a new depreciation amount of $500 a month. Whereas here, right, remember we were depreciating $1,000 a month. Okay, so you're by changing the useful life, you change the amount you're going to depreciate. So in essence, what you're doing is you're saying, okay, whatever I have left to depreciate, okay, when I make that change in the useful life, I take that amount and I recalculate it for the remaining period of time to get a new depreciation amount. Okay, and so basically that's how that works. Now, like I said, generally a change in useful life doesn't happen that often, but it does. Okay, I mean, it is. Personally, I've never actually had to do it. Okay, but when you're in really, really big companies, and remember, you're being, what you're doing is getting your bachelor's degree. You're being trained as a professional to be able to go into any industry and function at that professional level. So you need to know everything. So it doesn't matter if you're just gonna, if you work for a big company like Ford Motor or Caterpillar or something like this, versus a construction company versus just a small business that is a hotel. Maybe you have a Marriott or Best Western hotel, or you're the owner of a McDonald's franchise. You need to know all of these here methods. You're learning all of these methods because you don't know where you're going to end up once you get your degree. And like I said, in most of the smaller businesses, you're never going to have to worry about the change in useful life. Okay, but if you end up in a bigger company, it is possible that you might have to take that into consideration. Okay, for those who are going to be accountants, definitely it's important to remember, because if you end up working in a CPA firm, you'll come across that because CPA firms deal with a lot of businesses, big and small, and anything and everything is fair game that you have to remember. Okay, so with that said, again, for those who haven't had math for business and finance, you can read the chapter, do the homework problems, and you should be just fine. But if not, and for everybody else, go out to the student community, chapter 17, and here's the direct address. You can watch all of the 30 videos, and so this way I haven't repeated everything, and you'll be able to pick up the information. Okay, with that said, we'll move on to the next video, which will be the cost of repairing fixed assets. Oh, and by the way, if you don't understand something, definitely feel free to contact an instructor. Okay.